All right, so the basics of accounting transactions. First, you have to determine, is it an accounting transaction? And anything that needs to be recorded should be recorded, but not everything is. So first, anything having to do with cash is absolutely something that needs to be recorded because we need to keep very precise control on all the things that happen to cash, both inbound and outbound. Second, we look at things that meet accrual principles, and this is slightly complicated. Notice I would use the word slightly. I'll let you be the judge on how slightly it really is. We'll look at first the concept of you record revenue when you earn it. You recognize expenses as incurred. We talked about this in a prior class, but we'll look at this a little more closely because now we're doing the books. And finally, we'll look at accrued adjustments. And one example is the example we did in class the other day about tables, and a table costing us $500, but we have to allocate those $500 across all the periods of time which benefit from having the table. And that is a layman's description of what depreciation is. It's spreading the cost of acquiring a piece of equipment over the useful life of that equipment. And then there are some transactions that we don't record. One example are contingent events. These are contingent meaning it's not yet set. It might happen, yet it might not. So an example would be a lawsuit. You might be suing somebody who you believed infringed on your rights for your patent. We haven't won yet, and until you do, we don't record in anticipation what we might receive from a judgment. Second is a purchase order. A purchase order is one where we sign a contract that we're going to buy, let's say, 1,000 units of the product at $100 per unit. We are bound to honor that purchase order, but nothing's been shipped yet. Until they ship you the good, you don't have anything and you should not record it on your books. Third is a sales contract. Let's go the other side. You go to a customer and somebody signs a contract to you that, yes, I want to buy your product. Again, you cannot count that as your revenue until you've actually done the work or delivered the products that were called for under that purchase or sales agreement. So we're going to now put ourselves into Excel and we're going to look at the financial effects template. And what we're going to see is that it is just the spreadsheet depiction of the basic accounting equation, namely assets equals liabilities plus, right, equity, right? So we're going to look at how that works. And then a couple of notes before we look at the spreadsheet itself. Some of you have accounting background before and you've heard terms like general ledger. Well, the Excel template that we're going to use simulates a general ledger. It starts with beginning balances and then records everything that happened during the year. And if you add all those up, you have the cumulative effect of everything that happened that year. That's what a general ledger does. The lines on the spreadsheet on this template represent specific transactions, or at the very top, the beginning balance, and at the very bottom, the ending balance. Next is the use of the statements will come flowing from this. So we'll get a template, and then we'll extract the bottom line numbers from the last row and use every one of those numbers in a statement. And I emphasize that because if we don't use those numbers, it won't balance. All right, so this is the financial effects template. I'm going to show you a very simplified set of transactions just to show you how the mechanics work. Then we're going to do a slightly more elaborate one that is found in your book, and it relates to Apple. But let's just do one just to warm up. So at the very top of the sheet, you'll see the balance sheet is in blue and the income statement is in green. And we mentioned that we have the linkage or articulation of the statements. And that's why this last column here in the income statement, which depicts net income effect, is carried forward into this column in the retained earnings. Because as you recall, retained earnings equals a few things. It equals net income minus dividends. And there are some other adjustments, right? But I put these in gray to illustrate that it is the key action area where one statement, the income statement, is linked to the other statement, the balance sheet. Okay, let's start by digging in further to the balance sheet. Assets equals liabilities plus equity. So you should remember that. Assets are broken into the category of assets, including cash, but other non-cash current assets, like receivables and inventory, and then long-term assets, and you have total. So these comprise a summary of what's in assets. Liabilities could be current or long-term. Furthermore, we have to add the equity, which is comprised of contributed capital plus retained earnings. So that is the general makeup of the balance sheet. On the income statement, we have revenues minus cost of goods sold And we have other items such as operating expense, we call it SG&A, or selling, general, and administrative. We have other income and expense such as interest expense, and we have income taxes. All those are expenses that are subtracted in order to get to net income. And so this is a layout of the blue for balance sheet and the green for income statement. So let's start with a very simple example, and we only have 5 transactions, and we just started the company. So beginning balances are zeros. We have nothing in cash and nothing in other items. Then we're going to start the year. We're going to start by having stock where you purchase stock, but the company receives cash of $100. A plus number means it went up, and a minus number means it went down. So all of you are used to like old accounting jargon like debit, credit, or T accounts. This is simpler than that. So just stay with the notion of if it goes up, it's a plus. If it goes down, it's a minus. All right. So cash goes up with 100. And what did you get that 100 for? Stock. So the company received $100. It went up. And the company issued some stock. That goes up, plus 100. And notice this equal sign is maintained, right? Because 100 equals 100. Oh, by the way, you just did your first accounting entry. Next, we're going to borrow 100 or $50. So what happens when we borrow money? We get money. $50 goes up. And did we issue stock? No. We have liabilities, and let's just call it a loan. And so this is 50. And next we buy inventory. So we spend some money. What happens when you spend money? It goes down, right? Down is a negative. Negative 40. And we have other current, non-current assets, and we have inventory. And that goes up by 40. So notice what happened here. Cash goes down by 40, inventory goes up by 40, and the left side of that equal sign equals 0. So 0 equals 0, we're in balance. Next, we sell half of the inventory we just bought to a customer for $50. So this one's a little tricky. It's recorded in 2 sections. First, we record the revenue side, then we record the cost of goods side. So let's start with the money side. We got $50 in cash. Customer paid us $50. So cash goes up by 50. And we have revenues. So way over here, we have revenues of 50. All right, so now this is the first entry. We're in this green section. So revenue goes up. By that transaction by itself, our net income would go up. Retained earnings would go up at 50, which means retained earnings, the linkage, goes up by 50. All right. So the way that worked was we had revenue go up 50, which has a positive net income impact of 50, which then carries into retained earnings of 50. But we have cost of goods sold. We didn't just get money for nothing. We had to sell or subtract $20 because we gave up half of our inventory. So if all the inventory was 40, then half is 20. So inventory. And this is a cost of goods sold. So it's a subtraction from net income minus 20, which has a negative impact on our income statement, which also has a negative impact on our retained earnings. All right, so we see that. Then we pay rent. So we pay rent, negative 10, because cash went down, and rent, I'll just put here as other, of negative 10. Negative 10 because it's reducing net income. So it reduces net income, which reduces retained earnings. And that's it for our transactions. Now, you've noticed that I'm doing something very repetitive and something that you think Excel is smart enough to do. Notice that I took a number here, which represented some transaction or some calculation based on what's to the left of it. And whatever happens here, I put over here, right? So some of you are very good at Excel. Some of you are very new to Excel. So I'm going to show you a programming trick. It's not really a trick. It's a function inside Excel. It's called an if statement. So first I'm going to do is I'm going to just do it for this column here. And I put if, and I'll just look for if anything on the left is going on, then I want to do something. If nothing on the left is going on, I do nothing. So if, open parens, if what? If the sum, open parens, of the things on the left, close parenthesis, is equal to 0, then nothing happened. Then I'll do quotes, a couple of spaces, close quotes. Otherwise, I want to sum what is over there. So otherwise, sum, S-U-M, what's on the left. So here we see, I'll put F2 in Excel, shows you the formula. So you see here, if the sum of this here, blue, of S18 to V18 equals 0, then nothing. Just put in blank. Otherwise, put in what that sum is, in which case it's 10. Here, do the same thing. I'll just make it blank first. So we go equals, if this is over here is equal to 0, equals 0, then forget about it. Leave it blank. Otherwise, I want that number. And notice it's minus 10. So let's go backwards now. And let's go backwards and try out our formulas. I'm going to copy this command. This is the if command right there. If. Copy that all the way through. From the top to the bottom. And I'm going to do the same thing here. That if command was right here. Right there, F2, you can see it. Copy it from where? From the top to the bottom. Okay, now we're ready to go. Step 4, we sold half inventory for $50. $50 is our revenue. Wow, magic, right? 50 is greater than 0, so it shows up here. 50 is greater than 0, so it shows up here. So this is an example how a function, in this case an if command, otherwise known as Boolean function, but most people call it if, can be programmed right into Excel, save you a lot of work. So the next transaction was we have to sell inventory. Cost of goods sold is minus 20, magic, right? And next one is we paid rent. Rent of $10. Done. Okay, so you see how handy that if command was? If you don't know how to do an if command, don't worry, I'm not testing you on Excel, but I will embed this in the spreadsheet template for you, so it saves you a little bit of work. And furthermore, it's just good to learn Excel all along your year here. So at the end of the year, you're going to be much stronger than you are today in Excel. All right, so now we've done all the transactions, and I can do a sum command, equals sum, and that's just adding up numbers. And I shade by holding the shift key. I lock it in a cell, hold the shift to shade what I want, close the parentheses, hit enter. So that's 150. I'm going to do Control C to copy. I'm going to copy this all the way over here. And now we see we have $100, which is the sum of all of these transactions. We have inventory, which was 40 minus 20, so there's 20. All these are zeros. We have $50 of loan. We have $100 of common stock, and we have $20 of net income. And on this side, we can do the same. Okay, and let's fix the shading. So I'm going to pick this cell, hit home, and do the color, and I'm going to do shading. Same thing here. I want to do shading. All right. So now we have these transactions, and now we want to test, are we in balance? So the formula is assets equals liabilities plus equity. So let's sum all the assets. So assets, and shift to lock, shaded, close parens, total assets of 170, and the equals sum, go up to the first cell and sum all the way across, close the parentheses, equals. So 170 equals 170, so we are good to go, right? See, that's equal. Now that we're in balance, I've gone ahead and done a mock-up of a balance sheet. I have some categories we don't need. I just want to show you general form. Balance sheet equals assets equals liabilities plus equity. So let's start. What's cash? I'll just do plus 150. And what's inventory? Plus the cell. What's total current assets? That's a sum command or a plus command. Let's just use pluses. It's plus that, plus that. You could also start with the equal. So we could have started with equals that plus that. Notice I always point. I hate typing cell references. Why? Because I have a typo. It's easier to see something by pointing at it with your cursor and then selecting it. And enter. So total, and makes sense, 150 plus 20 is 170. There are none non-current assets, so 0. Total assets equals current plus non-current, so 170. Accounts payable, we had none. Loans payable, yes, we have a loan. How much is that? It's 50 right here. Again, I point to it, enter. Total liabilities equals that plus that. Okay. Contributed capital, yeah, we put in 100 bucks. So plus the 100. Retained earning, yes, we made money. How much? We made 20. So the total equity equals that, retained earnings, plus that, contributed capital, 120. Liabilities and equity, plus liabilities plus equity. Notice that I tend to use plus more than equal. It's just because it's easier on a keyboard. It really doesn't matter. So now we have assets of 170 equals liabilities of 170. So now we have a balance sheet that balances. Now let's do the income statement. Revenues plus, that's the revenue column. Next is cost of goods sold. It was 20. Gross margin is plus 50 plus a negative number, which is subtracting it, and that's 30. And our operating expenses, we only had one type of expense. That was rent of 10. So operating income is plus gross margin, and then subtract the expenses, and I already put it as a negative, so I just plus it, 20. We had no other income and expense, so therefore pre-tax equals 20 plus 0, or 20. We had no income taxes. Net income equals pre-tax plus whatever expense we have in income taxes. Of course, we didn't have any in this simplistic example, and we're net income of 20. So we're done, right? What we've done, just to recap, is we have our template, and then we put in the beginning balances. Then we recorded each transaction. Again, very simple. We only had 5. Then we did the totals to get to trial balance once we're in balance, and verified it with this section here where 170 equals 170. Then we can go to statements, and we generate both the income statement and the balance sheet. Now normally we would generate the income statement first and then the balance sheet, but this particular example is so simple I just went ahead and started with the balance sheet since it had more action. Proper form would have to do income statement first. So we're good to go? Perfect.